What if I told you we could figure out the best way to invest your very first $100, all based on a real-life 4-year experiment? Well, that's exactly what we're going to do in this explainer.
Okay, let's just jump right in. We're here to tackle a really simple but honestly super important question for anyone just getting started. What is the absolute best way for a total beginner to invest just $100?
So, to get to the bottom of this, we're going to follow this experiment from the very beginning to the very end. First up, we'll look at how the whole thing was set up. Then, we'll meet the 5 different investments that were put to the test. After that, and this is the fun part, we'll see the actual 4-year results. And finally, we'll land on what seems to be the beginner's best bet. All right, Section 1, the $100 experiment begins. And let me tell you, this wasn't just some thought experiment. Nope, this was a real deal, 4-year challenge with actual money on the line to see what would happen in the real world. So how are we going to judge these investments? Well, we've got 5 key things we're looking at. First, the learning curve. Basically, how hard is it to even get started? Next, passive income. Can it make you money while you're just living your life? Third, tax efficiency, which is super important. How much of your profit do you actually get to pocket? Fourth, the big one, risk level. What are the odds you could lose everything? And then, of course, the grand finale, the results. Okay, it is time to meet the 5 contenders in this investment showdown. We're putting them head-to-head in a direct comparison to see who really comes out on top. First up in the ring, we have individual stocks. Now, the idea here is actually pretty simple, and let's be honest, kind of exciting. You get to own a tiny piece of a company you really believe in. When they succeed, you succeed. But, and this is a big but, to do this well over the long haul, it's not just a guessing game. You've got to be willing to roll up your sleeves and dig into the nitty-gritty, like income statements and balance sheets. So let's break down the scorecard for stocks. The learning curve gets a high rating, and that's because of all that research we just talked about. Passive income is rated good, mostly because of dividends that companies might pay out. Tax efficiency, great, especially if you're smart about it and use something like a Roth IRA where your money can grow tax-free. But then, look at that risk level. It's high. This is a classic high-risk, high-reward play. You could win big, but you could also lose it all. And to really hammer home that risk, check this out. To pick the stock for this experiment, the guy literally put on a blindfold and threw a dart at a board with 20 different stocks on it. And where did it land? Samsung. It's kind of funny, but it really shows you just how much pure dumb luck can play a role when you're betting everything on just one company. All right, contender number 2 is something called a real estate investment trust, or a REIT for short. Now that sounds way more complicated than it is. The concept is actually really cool. Just imagine you and a bunch of friends pool your money to buy a house. Then you rent it out and you all split the rental income. Well, a REIT is basically that, but on a massive scale. It lets you invest in huge properties like shopping malls or office buildings without needing millions of dollars to buy them yourself. Now, the big headline on the scorecard for REITs is that great rating for passive income. And there's a really specific reason for that. By law, REITs are required to pay out at least 90% of their profits to shareholders as dividends. That makes them a potential powerhouse for anyone looking to generate a steady stream of income. The risk here is medium, so a bit safer than putting all your money on one stock, but definitely not risk-free. Okay, on to our third contender, and it's a big one. Cryptocurrency. You can think of it as digital money. Bitcoin is the most famous example that isn't controlled by any central bank or government. It's kind of part investment, part wild speculation. You keep it in a digital wallet, and you'll often hear Bitcoin called digital gold. Why? Well, just like real gold, there's a finite supply, and that scarcity is what can make its value shoot up. So when we look at crypto's scorecard, it's a mixed bag. The learning curve is moderate because, you do have to get your head around things like wallets and exchanges. But just look at that risk level, very high. This is the definition of volatile. The price can go to the moon, but it can also crash and burn just as quickly. And another big one to notice, tax efficiency is poor. You can't stick it in those nice tax-friendly retirement accounts, and believe it or not, just trading one type of coin for another can trigger a tax bill. Next up, we have contender number 4. Good old gold. This is the classic safe haven asset. For literally thousands of years, people have turned to gold to protect their money when things get shaky in the economy. Now, you could go buy physical gold bars or coins, but for most of us, it's way easier to invest through something called a gold ETF. It's basically a fund that holds a ton of gold, and you can just buy a share of it. Easy as buying a stock. And this scorecard really tells you everything you need to know about gold's specific job. The learning curve is super low, and the risk is medium. But look closely at passive income. It says 0. That's because gold doesn't pay you anything for owning it. It's not a company, it doesn't generate profits, its one and only job is to be a store of value. Think of it like a sturdy anchor in a stormy financial sea. And that brings us to our final contender, the index fund. This one's a game changer. Imagine you could buy just one thing, but that one thing was a basket that held a tiny slice of the 500 biggest companies in the US. We're talking Apple, Microsoft, Amazon, all of them, all at once. That's exactly what an S&P 500 index fund is. It gives you instant diversification. You're not trying to pick the winning horse, you're betting on the whole race. And would you look at that scorecard? It perfectly reflects how simple and powerful this is. The learning curve is low. It is unbelievably easy for beginners to get started. The risk is also low because you're not exposed to just one company. Your money is spread out across hundreds. You get some decent passive income, great tax efficiency. It is basically designed to be the ultimate set-it-and-forget-it investment. Okay, we've met all the players. The stage is set. This is the moment we've all been waiting for. Let's dive into the 4-year results and find out which one of these $100 investments actually won the challenge. And here they are, the final numbers. Wow. So after 4 years, that single stock pick, Samsung, actually lost money. It was down over 32%, turning our $100 into less than 68. The REIT basically broke even. Gold did pretty well, a nice 40% profit. The index fund, very solid, almost an 80% return. But the absolute, undeniable runaway winner, it was cryptocurrency. That initial $100 invested in Bitcoin exploded to over $650. This bar chart just says it all, doesn't it? It really puts that massive difference into perspective. Just look at the insane height of that Bitcoin bar compared to everything else. It is the perfect picture of a high-risk, high-reward scenario. And then you look all the way over on the other side, and you can see that poor single stock pick, which ended up losing a pretty big chunk of that starting cash. So that's it then, right? Bitcoin was the big winner, so case closed, everyone should just go buy crypto. Well, not so fast. This brings us to our final and maybe most important section, the beginner's best bet, because the winner of the race isn't always the best choice for you. So what should you do with all this information? Okay, look, while that Bitcoin return was absolutely spectacular, you have to remember that's not normal, and it came with a stomach-churning amount of volatility. The index fund, on the other hand, delivered a return that was, well, pretty much exactly what you'd expect. It was right in line with its long-term historical average of around 8 to 10% a year. And that is the key point. It represents a reliable, predictable, steady way to build your wealth over time. And here's some great insight. The expert who actually ran this whole experiment shared his own personal strategy, and it's a fantastic model for beginners. The vast majority of his money, his core, is in reliable index funds for that stable long-term growth. And then he sprinkles in smaller percentages of these other assets, some individual stocks, some REITs, and even a little bit of crypto to balance everything out. So after seeing all of this, what are the real lessons here? It all boils down to a few simple, timeless rules. First, start early. Seriously, start as soon as you can. Time is your absolute best friend in investing because it lets the power of compounding work its magic. That's when your money starts making money, and that money starts making more money. It's a snowball effect. And the second big lesson, which this experiment showed so clearly, is that diversification is absolutely key. Please do not put all your eggs in one basket. Look, the results of this whole 4-year experiment give us an incredibly powerful roadmap for getting started. But you know what? A map is totally useless until you actually take that first step. So your investment journey officially starts right now. The only question is, what's your first move going to be?